Hi, I'm Jeff Thurecht, Director from AAN, and today I'm joined by Chris Yates, Director from BetaShares, to talk about BetaShares and their role within our portfolio. So thanks for coming on, Chris.
Thanks for having me, really appreciate it.
So as a starting point, can you maybe give us a background on BetaShares and investment philosophy and how the company works, please?
No worries. Look, BetaShares, we're an ETF fund manager. What probably makes us a little bit different in Australia is we're the only Australian founded ETF fund manager, so I guess we play in a pretty big ballpark with some of those global players, Vanguards and iShares of the world, which are fantastic fund managers in their own right. We just at BetaShares do things a little bit differently and have, a different way of approaching ETFs. And that comes back to, that Aussie-centric focus and Aussie-centric lens being an Aussie-founded business. So where we're at as a business really is we are actually the second largest in terms of total inflow into ETFs, which is quite surprising to a lot of people. Again, we do play in that sort of large playground of those global players, and they're quite surprised to know that a little Aussie business is able to sort of compete in that space. And again, that comes back to how we look at the ETFs that we list. And with that kind of probably answers your question around sort of the approach or methodology of a lot of those ETFs. A lot of ETF fund managers will typically look at one style of ETF, be it a low-cost passive way of investing, which 100% works in certain markets. But we sort of look at it more at BetaShares of what's going to deliver, the maximum value to an Australian investor instead of just purely maybe cross-listing US exposure that works well there. In Australia, we take it on, well, is it better to be low cost for this particular exposure? What is a traditionally hard marketplace for an Aussie investor to actually access? International markets for an Australian investor is notoriously expensive and hard to actually tap into. So it's looking at that in terms of that type of value we could provide. Alongside that, we are agnostic in terms of the style of ETFs that we bring out. Again, not just looking at low cost passive, we actually look at, well, yes, that makes sense in highly efficient marketplaces, and we'll look to bring out the lowest cost possible exposure in that space. Where there is more inefficient markets, we'll tend to look at, well, can we actually apply a filter or a smart beta or factor approach to maybe overcome some of those efficiencies, or give a certain style of ETF that traditionally investors may have had to use active managers to tap into that.
So just before you go on, taking a bit of a step back, so ETFs being exchange traded funds, so typically, and as you're sort of referring to, they have taken a pure index approach, and most people would think about that from the viewpoint of a well-known index like the ASX 200 or S&P 500 or something like that. And that means you effectively just replicating that index and buying everything which is in that index.
Correct. Yeah.
And then so when you're talking about some of the the value add, you talked about the filters that you apply and the different styles of products that you might have. So maybe with that background, talk us a little bit about some of the different things that you're doing, which I'm interested in. I know you're about to get to, so sorry to interrupt.
No, perfect. Look, exactly right. So, low-cost passive definitely works in highly efficient markets where there's not much price discovery. Active managers tend to find it very hard to outperform sort of those relevant benchmark indexes. But when you look at sort of more sort of inefficient market spaces, small caps, parts of global equities, especially fixed income. Fixed income, and sort of, if we look at that, is traditionally liability weighted, which means that that index essentially is giving the investor exposure to the most indebted companies, or parts of that is what your client's getting exposure to, which is kind of counterintuitive when you think about fixed income.
Or the most indebted countries as well sometimes.
Yeah, exactly right. So we took a very differentiated approach to building out our fixed income suite for Australian investors. We actually disaggregated something like the Osborne composite down to the return sources. We took out the inefficiency of liability weighting by equal weighting our indexes. So not one issuer or not one country, for example, if it was internationally we're talking about, would be overwhelming the index depending on how indebted or how much debt they had issued.
So maybe a good way of unpacking that a little bit is to think about a common sort of index that people might understand is the ASX 100 or something like that.
Yep.
And so that's heavily weighted in Australia to the banks,
Mm-hmm.
and BHP and the like.
Yeah.
So if you were to have a standard index, that would buy those companies in that weight that they appear in the index.
Yeah.
Right? So an equal weighted, how's an equal weighted product differ to that nature?
Yeah, exactly. And again, you look at something like ASX, or we can take the S&P 500, which is a really good example as well at the moment. You look at that index, it's heavily weighted to those top 5 or 6 companies, which are those tech names.
Yeah.
The sort of concentration risk, or the concentration of those particular companies within that index, is the highest since back in 1970.
Yeah.
So you can look at something like an equal weight strategy, which will overcome that, I guess, issue or inherent risk of people worrying about the performance of a handful of companies in terms of the whole index.
Yeah.
So by equal weighting it, you're sort of distributing the weight within the index evenly for the S&P 500 to 0.2% weighting across that whole index.
So as opposed to those top 5 stocks, how much do they have?
Yeah.
What's their weighting in?
So they're about 27% currently.
Yeah.
So you're going to downweight those.
So they'll then be 1% of the equal weighted portfolio, because it's 0.2% roughly.
Exactly. So you're going to get that even distribution of exposure across those companies. And the same thing can be said about the Australian index in itself. Your top 20 companies are taking up sort of 56% of their market capitalisation, and that's tending to be your banks and your resource companies, which is sort of the large component of that. So again, the underlying performance of that index is going to be tied to those big, large, cyclical names. Yeah. And depending on where we're in the market cycle, can be sort of, I guess, detrimental to the overall performance of that type of index. So it's really sort of the evolution of index methodology. I think it's just sort of what it's called is how you construct that index from simplistic market capitalisation, which means however amount of shares you've got issued at the current price is the size of that company, to these more sort of smart beta or factor-based ETFs that are just using sensible screens or certain factors to actually sort of size those companies or give exposures to certain markets.
Okay. So, I mean, as you referred to, that your BetaShares has benefited from some fantastic growth in the sector.
Yep.
There has been an explosion of, I guess, different types of ETFs, but the use of ETFs and the popularity of ETFs, and I think most people watching along at home have probably heard of ETFs now, whereas 5 years ago that might not have been the case. What do you think has been some of the sort of key drivers of that focus and the increase in demand?
Yeah, it's a good question. And look, there's been massive sort of adoption of ETFs, especially over the last sort of 5 to 6 years. For us as an ETF fund manager, we're at 17.4 billion now for just BetaShares. Yeah. I started in the business about just over 3 years ago, and we were only at 5 billion. Although I do tell my boss that the reason for the explosion in fund is because of one reason. But no, there's been a massive sort of weight of money moving into the ETF structure, the ETF investments. Last month, at the end of March, we just tipped over 100 billion. So the reason for that, I guess, is ETFs, I guess, if you look at them compared to your traditional unlisted managed trust structures, which your clients would probably be very used to seeing in their portfolios traditionally. When you look at them in terms of how they're structured, they're under the exact same sort of regulatory framework, which is a really key thing. So you're not moving into a completely different regulatory framework to use an ETF. The ETF has just been structured in a way that it can be accessed via the ASX. So it wrappers around that structure to, I guess, make it available not only to advise clients, but to your retail clients and institutions, non-for-profits. Anyone that can access the ASX can actually essentially access these strategies. And I guess the uptick in terms of inflows into the ETF industry really is, I guess, that evolution around what type of ETFs they are there. You roll back the clock 10, 12, 15 years ago when the first ETF was listed in Australia. It was, as we mentioned before, simplistic market cap, which meant that if you didn't believe in passive investing, you probably wouldn't use it. Now I guess people are getting more conscious around fees, which is another real sort of reason why they start looking at an ETF. Fee conscious, net of fee returns, can our active manager outperform their particular asset class, or they're looking at things like, well, there's some pretty unique exposures within that ETF wrapper now. So it's not just simplistic market cap. There's smart beta, there's certain sectors. You can get into technology, you can get into Asian technology, you can invest in
Some
global.
weird and wonderful ones.
Yeah.
Isn't it?
And we're sort of the backbone of that weird and wonderful. We've got
Yeah.
64 ETFs, and there's some pretty interesting ones that we get exposure to for Aussie investors now. But you can, not just around sectors or thematics, there's strategy-based ETFs for those income-focused clients, managed risk strategies. We've got ones where you can invest in currencies, you can get geared exposures, short exposures over particular markets to hedge out portfolio risk. So I think it's obviously the adoption has really come down to, I guess, the investment universe is a lot broader now. And, for us, again, being agnostic, we have active ETFs. So high conviction active strategies that everyday retail investors can now access instead of it only being those who are going through an advisor or having to go through M funds or put a paper application in. And that was always a hurdle as well, the accessibility of it, not just in terms of how you access them, but the dollar value. An ETF can be traded at $500 basically through ComSec.
Yeah.
Where a minimum investment on some funds can be anywhere from $10,000, $50,000 to $100,000.
Yeah, that's right.
So I think that sort of really broadened out a lot of the people that can use and are using ETFs as well.
Yeah. So Chris, there's a huge range that BetaShares is offering, and AAN is really pleased to be partnering with you using a number of the different products. So we maybe segue into a conversation about some of the specific ETFs that are in the portfolios, AAN model portfolios.
Perfect. And again, thank you, to AAN to taking that rigorous process in terms of reviewing those ETFs and including them into the portfolio. So we appreciate the support. That's what's got us to where we are today as, Aussie investors. So, look, we've sort of covered off one of them and highlighted one of them, which is the Australian 200 ETF, which was included last year. The reason what that fund is again, it's a low-cost, broad market Aussie equity exposure of the top 200 companies. That was included in the portfolios because, again, back to that, view of how we look at the ETFs that we bring out and what's going to deliver value. The value in a broad market index is how low can you actually make that index?
Yeah.
And it's the lowest cost in the world at 7 basis points. So the inclusion of that to that particular to those portfolios is really a benefit to your clients because they know they're getting the lowest cost of equity exposure.
Yeah. And that gives us the broad access to all of the companies in that. So as the market goes up, and that's where people are watching the news and they're saying, this is the share market return. That's what they're referring to, isn't it? Effectively,
exactly right.
200. So it gives us that exposure to those companies and the ability to sort of check in on that, watching the news, and then building around that or adding to that, there are things that have been done differently, which we've got some active managers in, and then we've also got some other ETFs by BetaShares in the portfolio.
Exactly right. Market cap, simplistic, but again, when you watch the news each night, that's what's, driving the core part of your Aussie equity portfolio.
Yeah.
Outside of that, the other ETFs that have been included in the portfolios, there's a couple of our fixed income ETFs. Again, something quite surprising that everyone isn't too aware of is that although we do have 64 ETFs and some pretty fun and exciting ones, our largest ETF is still cash. So cash is still king in Australia. And this is an ETF that's actually one of the ETFs that's still only the true cash ETF. I think there's a few cash ETFs last year that had to get rebranded essentially because they weren't holding at call cash. And when we saw that sort of credit spread movement, they actually saw a bit of volatility in the capital value of it. Yeah. So that fund there is our Australian high interest cash ETF under AAA, is the ticker code. It's $2.4 billion. So a very large fund.
A lot of cash.
A lot of cash. And again, that grew by about $1 billion over the last year. So we're seeing a lot of money sort of continuously move into that. Look, it's I guess why I think a lot of people do select that, and AAN selected it, is you're getting 100% capital stability. So it's cash at call, diversified across 7 Australian depository institutes. So there's no sort of capital risk taken from using that fund, which is obviously very important when you're investing in cash. Yeah. The other reason is really because around where interest rates are. We're in an ultra low interest rate environment. Platform cash, where a lot of client monies are held, are paying nothing, unfortunately. And then when you take into account sort of platform fees, etc., you're probably going backwards. So AAA is just a nice, efficient way of at least getting some level of yield and income for those clients, especially those ones that are, more income orientated. Yeah. And again, looking at alternatives, your traditional term deposits are pretty much paying, at a relative interest rate. but you're locking your money up for 6 to 12 months. And the real benefit of AAA being an ETF is T+2 liquidity. So if your client needs that money for whatever reason, you can deliver it to their bank account in T+2 days.
Yeah.
So it's giving you that liquidity, which is really important.
Yeah, great.
Moving on to the next one, is another one of our fixed income exposures, which is Coupon. It's an Australian senior floating rate bank bond fund. So it's giving, I guess, access to, a particular part of the market that retail investors traditionally probably didn't really have the ability to invest in, because Big Four banks and our 5 regionals, when they put these allotments out for these senior floating rate bonds, they're very large, and most retail investors probably don't have $500,000 to take a position in that.
Yep.
So the ETF for this one's really just giving an access point to retail investors or advisors, but also for in their portfolios, it's a very capital stable position. So when you look at the capital structure of the bank, cash is at the top. Senior floating rate bonds is just below that.
Yep.
So you're not taking on any sort of interest rate risk, which is one of the things that's a big concern at the moment, is seeing these long-term interest rates ratcheting up pretty sharply. Anything that has interest rate risk or duration risk is seeing the capital value actually sort of being quite volatile. So this is a floating rate exposure, so you're not getting any of that interest rate risk. So again, it's not cash, it's slightly a step away from cash, so you're getting the benefit of that in terms of the income or yield off it. Also because we have that smart beta strategy in that space, you actually pick up what we call roll return. So it's a very neat solution in a very ultra low interest rate environment.
So maybe what does smart beta mean, and what is the role?
Yeah, so smart beta again is we're not taking a traditional fixed income or liability weighted index, so we're not just simply going out and buying the biggest issuance of bonds. So there's 13 bonds in that particular portfolio, which are floating rate bonds. 8 of them are going to be from the Big Four, and 5 of them are going to be from the regional banks. And they're evenly distributed or equal weighted.
Yep.
And what we do, instead of, I guess, a lot of traditional bond indices will hold those bonds all the way to maturity. But what you can do, and what basically active manager does, will roll out to the newly issued bond. And when they do, what you do is you can pick up what's called roll return. So you're crystallising a capital gain, and that gets passed on through to the end investor. For something like Coupon, just the shape of the curve currently, you're getting an additional sort of 30 basis points of return, which again is pretty meaningful in an ultra low interest rate. So again, it's a really sort of neat exposure that you're not taking on much capital risk, which is important.
Great. So they're very much filling out those two, particularly the conservative part of the portfolio and short to medium term sort of needs.
Yeah, exactly right. And again, we've seen in terms of inflow, very strong inflow into that type of exposure, especially now.
Great. So our newest partnership is around the AAN Sustainable Growth model.
Yep.
And BetaShares has 2 funds, or two ETFs in that model. So can you talk us through those ones, please?
Yeah, no worries. And look, it's been great working through that process. Obviously, ethical investing is such a huge growth area in Australia and globally at the moment. We're seeing a huge weight of money move into ethically focused or ethically tilted ETFs. You look at, say, but just between the US and Europe, there's about $7.4 billion going to ethical ETFs there. And as we've seen over the last sort of 3 years in Australia, there's about $3.4 billion.
Yeah.
Where we sit in terms of that space and the funds that you use, we're about 3/4 of that.
Yeah.
So we've had very strong adoption in our ethical suite. We've got 8 ethical funds now, which cover Aussie Equities International, Hedged International, a diversified fixed income exposure, 3 diversified funds, and also a new climate change and innovation ETF as well. So it's a huge growth area. The funds in particular that you guys have selected is our Global Sustainability Leaders Fund in ETHI, which is our largest at 1.2 billion, and also our domestic one, which is our FAIR ETF, which is our Australian Sustainability Leaders ETF. I guess that process of what you and the investment committee went through was looking at those ETFs and why were they selected, and I guess why broadly we've seen them sort of adopted in a lot of retail and advisor portfolios is we took a pretty unique approach in the construction of them and the methodology that we put in and the screening processes that we applied to them. Because traditionally, I guess, looking 3-4 years ago, there was very limited options for ethical ETFs at that time. And what was there probably isn't what we'd deem as true to label, so a very light screening process. And the other option, of course, always there was active management, which, you know, you come with active management, you get the higher fee. And also, I guess, with ethically investing, you kind of want a bit more transparency. And obviously with an active manager, of course, they don't want to give away their whole portfolio because that's their IP. And also there's that element of subjectivity as well, because you're really sort of relying on whatever the ethical beliefs of that portfolio manager.
And that's a challenge, isn't it? Because everybody has a slightly different take on what ethical investing is or sustainable investing
Exactly
is.
right. It is. It's sort of, you know, what's ethical to me might not be ethical to you, or what might be important to me might not be important to you. So looking at that and looking at those issues, we really saw a unique space to bring something out that would fill that void, that grey area of those sort of varying ethical beliefs, whilst also applying and identifying climate leaders within that, and doing it in a rules-based strategy that's going to be low cost. And we managed to do it, which is great. So,
well done.
Yeah, I didn't do it, but it's good to go out and talk about it, because I guess that screening process, and we've got a really, really neat chart that sort of can detail it, and a lot of advisors use that as a way of actually talking through their client around what do they actually want and what they don't want within their portfolios. And in terms of the global one, ETHI, which is our Global Sustainability Leaders ETF, the way we look at that and the process we've put in terms of identifying climate leaders is you have to be looking at developed markets, so we're not going into sort of those illiquid and undeveloped sort of places in the market, but developed markets, but you have to be in the top third of carbon emissions for your industry. So that is our positive screen, if you want to sort of look at it in that way, that they're a climate leader within their own sector. Then what we do is actually put them through what we see as the most rigorous screening process of any ETF. And by that, we don't just go, well, you're in fossil fuels, therefore you're out. We actually go granular down to where you drive your revenue from. So, you know, you look at, say, fossil fuels, yes, you would be out, unfortunately, but if you're in direct lending to fossil fuels, by more than 5%, you're also excluded. And then we go through, you know, everything from animal cruelty, supply chain issues, payday lending, even down to gender diversity. If you don't have one female board member at that executive level, you're screened out. So by taking that really rigorous approach through the screening process, it means that the ethical investors that are looking for a solution in that space will usually find the thing that they wanted to align to, and maybe not necessarily the other parts were exactly what they were concerned about, but they're more than willing to sort of come on that journey by using that fund, which is true to label.
It's covering a fairly broad range of the popular or common issues that people raise.
Exactly right. And you know, with your SMA portfolios, you've got your own sort of ethical framework and governance around that. And having that transparency and those tolerance, you can actually sort of align the fund to what you guys want as well, which is really important. Same thing with FAIR, similar sort of process. What we use to identify climate leaders is we identify companies that are deriving more than 20% of their revenue from sustainable activities. Unfortunately, we can't apply the same screen as FAIR because True Cost, which is a subsidiary of S&P, don't provide that type of data for Australian listed companies. So you're still getting that positive screen, you're getting the same screening process until the negative screens, which gives you that, again, true label exposure. And the really neat thing about these is there's always been that misnomer around ethical investing and performance. If you're screening everything out, what are you giving up? So the benefit to the investors that you have been using these within those portfolios is that ETHIs, you know, outperform most active managers, passive, active, ethical and non-ethical, and FAIRs outperform the ASX by around 4.5% since inception. So it really sort of takes away the misnomer of getting up returns. Yeah.
Fantastic. So just how is it actually done? So you talked about the research that you're getting to drive the ETHI sort of process and the screening.
Mm-hmm.
Is it, how much is done, I guess, by the computers, and how much is done, you know, how active are your team in actually talking to companies or exploring the different issues that are coming up in the ethical space?
Yeah, it's a good question. These are passive indexes. So there's a rules-based methodology, so a process that it works through. So we're not picking X over Y. We're going, are you in the top third for your industry on carbon emissions? Do you pass these screens? Once we have that eligible universe, we will select the top 200 for the global one, for example, and that's how it's done. So there's no subjectivity in terms of what we actually choose to be included or excluded from the index. So it's complete rules-based strategy. But what's quite unique with these ones is we actually have an overarching responsible investment committee, which is very unique.
Yeah.
So, companies will be in the index and things happen within companies, they'll merge with another company, or there might be some issue with one of the suppliers that they use. That responsible investment committee there is to ensure that they're engaging with the boards of those companies to help alleviate or give some sort of strategy or objective to overcoming whatever that issue is.
Okay.
So if you look at something like currently in the last quarter, the board and the responsible investment committee engaged with two companies, one within FAIR and one within EFI. Within EFI it was with Apple, but not Apple itself, but a Chinese-based lens provider for the touchscreens. And they were under scrutiny in terms of forced labour. So the outcome for that from a board level is they were engaging with that particular lens company, and if they are deemed to be using forced labour, Apple will remove them as one of their preferred suppliers.
Right.
So there's these sort of, overarching human element to what is a rules-based strategy. Another really good example would be a company that has actually been removed. And about 2.5 years ago, we removed Facebook.
Right.
Facebook, the board engaged with them around their fake news scandal that came out. Facebook came back and said they were putting in processes in place so that would not occur again. And then Cambridge Analytica scandal came out. And at that point, the Responsible Investment Committee did decide to remove Facebook from that particular global index.
Okay.
So again, it's not active, we're not making active decisions, we're just ensuring that the companies are continuing to operate within the, framework of our investors in terms of the ethical issues.
I think it's fantastic that you've got that method or that ability in place to have that level of liaison that's sort of backing up the true to label. You really actually putting your money where your mouth is in terms of that sustainability rather than just rolling along and taking their word for it.
Yeah,
that's a true step.
It is very unique, and it's again why we're probably seeing such strong adoption of those particular funds. Is there is that backstop there.
Fantastic. I think that's a great overview. I was going to say summary, but it was much more than a summary. We went fairly deep.
We went down a rabbit hole, mate.
Yeah.
You always do with sustainable investing.
Yeah, no, I think that's fantastic. And as you said, we went through a very rigorous process to put together the sustainable portfolio. All of the portfolios go through a very rigorous process. But it was interesting to have that extra layer that goes on from the filtering and reporting viewpoint and transparency viewpoint, the sustainable model, and certainly you guys stacked up very well there, which is how you ended up being part of the portfolio. So
perfect.
Fully supportive of the methodologies. Yeah. Before we wrap up, is there anything else that you want to add or speak about in terms of BetaShares, ETFs?
Oh, mate, where do I start? I guess probably we've talked about the ethical investing side of it, and some of more of the sort of vanilla core building blocks, which is always important to have that robust asset allocation building blocks underneath those portfolios. In terms of the ethical side, there's probably one that's a pretty exciting development within that space that we've just recently listed, which is our BetaShares Climate Change and Innovation ETF. I think there's been a lot of demand, and for these type of companies that are actually providing the products and services for companies that sit in things like EFI and FAIR to actually lower their carbon emission.
Yeah.
We've seen a massive amount of money go into these sort of impact style ETFs, and we've listed an ETF in that space, which is going to give exposure to the top 100 companies that are helping with the decarbonisation of the world.
So it's a global one?
It's a global one, exactly right. So it's quite unique in that it's a pure play within that space as well. So the companies that are in that particular index have to be deriving 50% of their revenue from those decarbonisation products and services and manufacturing. So there's that sort of diversification, but it's a pure play within that sector, and we've actually looked at diversification at the sub-theme level as well. So when you think of, decarbonisation, a lot of people get caught up with, say, green energy, for example, wind farms, and definitely that is a part of it, and definitely going to be a part of that ongoing solution to 2050 to carbon net zero story. But we believe that there's some other key areas within that sort of decarbonisation that are going to play significant parts in it. So things like enabling solutions, things that are going to help, fuel cells, water waste management, building out more sustainable products and services around that too. And also, of course, green vehicles, which are going to become more and more prominent and used. So that ETF is giving you the top 100, but also a diversification in those subsectors as well. And it's pretty exciting. It's one of the sort of mega trends we think are going to sort of roll out as the years go on. You know, there's some pretty eye-watering numbers in terms of how much money has to go into those particular products and services and sectors. You know, you see numbers around $1.2 trillion annually to get to 2050.
Yeah.
So again, for the ethical side of those portfolios, or even just that long-term growth thematic, it's definitely something, an ETF that we think is going to be a really good long-term growth play.
Definitely one to watch.
Yeah, exactly.
Sounds good. All right. Well, I think we've covered all we need to this time. We could talk all day probably on everything else that's happening in the space, and maybe get you back another time. But for now, I think we'll wrap it up there. And thank you very much, Chris, for your insights and wisdom. And
wisdom. Oh, don't get that much.
And pass on our thanks to the team for a great partnership we've got between AAN Asset Management and BetaShares. It's working well so far, and look forward to continuing into the future.
No worries, mate. And again, thank you so much for the support from the AAN Group and all the advisors underneath that, and really appreciate being through that process and that review process and helping other clients.